Hi there, welcome to Berman's Call. Larry Berman is here to take your questions on large cap stocks and exchange traded funds. There's the number, 1-855-326-6266, or email bermanscall@bnnbloomberg.ca. Larry, thanks for joining us. Remind us what you're looking out for in this forthcoming U.S. earnings season, please.
Well, earnings growth and a broadening out of the earnings growth, Andy. All will know that we've had a very, very narrow and strong leadership by the handful of tech names that have come to be known as the Mag 7 now. And it's really important for this bull market to sustain itself for earnings to broaden out beyond those handful of names. But make no mistake, it'll be artificial intelligence and what those companies tell us about the go forward that will largely set the tone in the coming weeks. Of course, this week we hear from banks, as we typically do to start off the earnings season. And there we've got rising interest rates and a steepening yield curve, and there'll be some information coming off the banks in that regard too.
It's interesting with these big tech stocks. I know it's not a fresh point, but they are super profitable. It's not like it's just speculative money based on future earnings.
It isn't. There's a saying in the market that a rising tide lifts all boats. But that speaks to the breadth of the market, right? You want more stocks participating. There's an awful lot of companies that just aren't making money or aren't making any significant money. When you look at the top line and you're looking at revenues versus the bottom line in terms of earnings, again, you're seeing earnings expectations and growth of 10, 12%, and you're seeing nominal GDP of 4%. And it's really getting more difficult to reconcile the two between what economic growth is going to deliver and what's coming with earnings. And if it's more concentrated, it tells you that if those companies miss, look out below. And so it becomes a higher risk market when the earnings aren't broad.
Larry, inflation, we've seen stocks were struggling earlier. Last time I checked, the S&P 500 had gone positive, but one of the weights on the market appears to be inflation stubborn. We may not get many rate cuts at all this year.
Well, that's it. The market went from pricing in a dramatic amount of rate cutting 6 months ago to virtually pricing out the entire rate cut path. Now, the Fed still thinks they're going to cut rates a couple of times, but the market now is down to one rate cut for 2025. So, markets, swinging quite dramatically here. And it speaks to me, Andy, it speaks to the narrowness of the market. Mm-hmm. And again, level of uncertainty. And if we do get some bad forward guidance on earnings, that's not going to be good for the market here.
Just in terms of U.S. inflation, though, maybe if you could put up a one-year chart for the U.S. dollar. Presumably that's good news for Powell, Jerome Powell, the Fed boss, in the sense that U.S. imports will be rising at a slower pace in price with that strong currency.
So, domestic inflation versus what we pay for things we buy from abroad. So import prices with a stronger dollar, sure. Mm-hmm. But that's a small part of the pie compared to the labor cost and everything else that right now is driving inflation. It's healthcare cost. It's all kinds of things related to supply and demand domestically that are driving prices higher and very little to do with exports. So while Trump is going to, incorporate tariffs, that is a concern. We saw that Friday in the University of Michigan sentiment survey where they were asked about forward expectations on inflation. And so people are really concerned, and it just makes it far more difficult for the Fed to add stimulus until we actually see stronger economic weakness. And for right now, the economy and labor markets are still ticking along. The weakness in the equity market is really much needed correction at this point.
Yeah, when you say much needed correction, there still is too much euphoria, do you think, or optimism in the markets, generally speaking?
You tell me, Andy, if 18 times earnings is normal and we're trading at 24 times earnings, mm-hmm. Is it egregious? No, but it's on the very, very high end of of the range. And so that, again, opens it up to risk if we've got a narrowly led market and we don't have a broad market, driving that earnings and growth for the markets.
We're looking forward to your answers to our viewer questions. Larry, thanks again for joining us. So Larry is answering your queries, your phone calls and emails on large cap stocks and exchange traded funds. There's the number 1-855-326-6266.